and welcome to Financial Minds Meet the Experts. I'm your host, Jamie Agostino. As you know, on this podcast, we're joined by financial industry experts to talk about topics, trends, and themes that credit union professionals need to know about. Today, we're back with our favorite Vizo financial economic gurus, Tim Sustak, our Chief Treasury Officer, and Scott Wood, Chief Investment Officer. Thank you both for joining me again.
Thank you, Jamie. Good to be here.
Jamie, happy to be here.
All right, so Scott, I'm going to start with you. Prior to the last FOMC meeting, you and I sat down and we talked. At that time, based on economic forecasts, we were predicting only a 25 basis point increase. But as we know, the Fed increased it to 50 or decreased by 50 basis points, which made the markets happy. Could you provide us with some insight as to why we saw a 50 basis point decrease versus the 25? Hindsight, kind of being what it is, was it a good move or not?
Well, I guess time will tell on that. Well, is it a good move or not? Yeah, I think a lot of folks were surprised. A lot in the market had been calling for 50 basis points, especially, on the equity side, and kind of to juice the economy a little bit, get things rolling. Free up, making the consumers things a little easier on them. But, when you listen to most economists going into that last meeting, it was almost exclusively 25 basis points. That was kind of the camp we were in. We thought it would be 25. There was always a chance of 50. It just wasn't a great chance. The odds were pretty heavily slanted towards 25. So then what happens, the Fed comes in and they cut by 50 basis points. Markets, like you said, they loved it.
Yeah.
Economists were, after the fact, everybody comes back and says, why did the Fed cut 50? There wasn't really, in my view and a lot of others' view, there wasn't a super compelling reason. So, for instance, the unemployment rate hadn't been jumping crazy. In fact, it had started to come back down again. So we kind of hit a peak of 4.3%. Right now, we're at 4.1% for the unemployment rate. So it's come down a little bit since that meeting, actually another tenth from 4.2 to 4.1. So, the Fed has just been stressing this dual mandate. The other side of the dual mandate is maximum employment. And that's what the focus is right now, is the employment side of the equation. So the 50 basis point kind of, juiced it up a little bit. And part of the thinking here is that the Fed maybe should have started cutting by 25 basis points in July at that meeting and kind of got the ball rolling. And then they could have done another 25 at this meeting. So a lot of the speculation was the Fed felt like maybe they missed the boat by not starting it early. And if you remember, when this tightening cycle started, when the Fed started raising rates, that was kind of the concern too. After the fact, the Fed was slow to start raising rates, and that led to higher inflation. So kind of the flip side of this was they might be slow to lower rates. And maybe that leads to issues that because they didn't start earlier. So by doing 50, it kind of alleviates that concern. Was it a big deal that they did 50? Is it going to cause the economy to overheat or any things like that? No, not at all. There's not really anything negative for them to do a 50 basis point rate cut versus 25.
Okay.
It just kind of got the ship moving a little quicker up front. Maybe it's the hybrid model where you pump the gas and you take off really quick. That's kind of what they did. They got a real quick start out of the gate here, maybe delayed by a meeting when they should have started, but they're kind of on track again now and heading down the road where I think the markets were really happy with the cut. It's been pretty positive since then, getting that 50. So what I will say, though, is there is a lot of uncertainty at the beginning of rate hikes and our cuts, and that's kind of why we thought the Fed would do 25.
Yeah.
Start off slow, let the market get used to it, and then maybe do a 50 down the road. But if you really want a good indication of what's going to happen a few days prior to the Fed meeting, you can get that in the Wall Street Journal. So normally the Fed will tip their hands. Nick Temeros is he's the reporter right now that the Fed normally tips off to, but it's historically been the Wall Street Journal. Greg Ip was the guy in the past, and it's other people over time that fill that role as people move in and out of the Wall Street Journal. But they normally give them a heads up because it's a quiet period, which we're in now, where the Fed members can't speak and let the press, or the community know what's going on. So we're in a quiet period. But if you want some real good indications of what's going to happen, look at Nick Timmerose, a few days before the Fed meets, and they normally, if they're going to do something surprising, they'll normally tip their hand to the Wall Street Journal.
Okay. So Tim, have we seen an impact from the 50 basis point decrease, or is it still kind of too early to tell? Have the consumers seen an impact, by the decrease as well?
Yeah, Jamie, I think overall it's probably still too early to tell and slash kind of not enough to make a huge difference at this point, probably. You hear the Fed talk all the time about kind of the long and variable lag of monetary policy. So it takes monetary policy some time to filter through the economy. And, depending what it is, you estimate, anywhere from 4 to 6 months to maybe, 24 months to get rate cuts or increases, rate actions, I should say, filtered into the economy and for people to feel them. So certainly, I think it's still probably too soon to tell. And then on top of everything else, I mean, we've got a time which we see prices and rates probably at lifetime highs for a lot of the folks that are in the market, right? And certainly at recent historical highs for all of us. So I think 50 basis points probably doesn't have that type of a huge impact we might see at other times, just based on where we are with everything going on in the economy. So I think it'll still be some time and further down in the rate cut cycle before we see any significant relief for the consumer. Though, consumer spending still continues to be good. The consumer drives the economy. We know that. Those that have the means are still spending, and certainly the 50 basis points isn't going to hurt. And for those that are struggling, the 50 basis points certainly isn't going to help that enough to be really meaningful for them, given where the level of prices are. So yeah, still a bit too early to see, but the whole point, and to Scott's point, is we took the big step off the ledge on the downward side for rates. So the Fed made a decisive start, and we'll see where it goes from here.
All right. Well, with that, the FOMC, Scott, meets next week, but we also have a presidential election next week as well. So some people don't think the Fed will lower rates due to the election. What do you think will happen at the FOMC meeting, and why?
Yeah, so if you look at Fed fund futures, there's some uncertainty there. They're not at 100% chance of a rate cut in November, and as you mentioned, it's the day after the election. So on the Wednesday after the election is when the Fed meets. So there is a chance that they won't cut rates. My thinking is it's going to be another 25 basis point rate cut, and part of the reason I say that is when the Fed met in September, they gave us a new dots plot. They do that every other meeting.
Mm-hmm.
So every 12 weeks, we get a new dots plot. So in that dots plot, they basically showed us another 50 basis points of rate cuts this year, meaning between November and December, we're going to see 50. So there's a chance, I don't think that view's changed based on what we've been hearing from the Fed, that they still anticipate doing 50 for the remainder of this year. It would make sense to do 25 in November and then 25 in December. But again, when you look at Fed fund futures right now, they're giving less than 100% chance of a 25 basis point cut in November. And they're also giving less than a 100% chance of 50 basis points through the remainder of this year. So the markets are not completely sold on the Fed doing 25 and 25. They're saying the Fed could skip and still just do 25. So rather than 50 the rest of this year, maybe get 25. Okay. I think there's still a really good chance they're going to do 25 next week, just to kind of keep things going. There's really been nothing to slow down or to say that they shouldn't cut another 25.
All right. Well, Tim, do you think they should lower the rate or stay?
I agree with Scott. I think they're going to go 25. For a couple reasons. First, all the reasons Scott mentioned. I think the recent Fed speak, you can hear that I think most still are interested in seeing further easing of rates because they still feel rates are restrictive. I think you look back at what the Fed had been saying during previous press conferences, and that is that although we have had some pretty decent economic data since the 50 basis point cut. But the thought process has always been, hey, one reading it doesn't make a trend, right? So I don't think at this point that they'll look at it and say, geez, we did 50 and our mindset was to really start down this path. And now we're going to stop and see based on some decent data. I think they'll need to see more of that before they would want to institute a pause. So I think it's another 25 basis points in November. I think they stay on the path for a little while. And I don't think they take a pause maybe till, the new year.
Okay. All right. Scott, I've heard some people, they're concerned about the value of the dollar. The third largest expense to the US is the interest on our debt. What are your thoughts on this topic?
Yeah, it's kind of scary right now when you look at the level of debt we have in this country. It is a third largest expense. We're spending over $1 trillion a year in interest payments right now, which is really unfathomable. $1 trillion a year just going towards interest on money we're borrowing. And if you look at projections by the CBO, they are showing no slowing down. So let's just say, no matter who gets elected, if either candidate comes into office and just leaves everything as is right now, with nothing else that adds to the debt, then we're going to be much higher. So the levels we're at today as a percentage of GDP are levels that we haven't seen since World War II, when we were funding a war that we were actively involved in. You keep hearing about all these issues with potential Social Security shortfalls, Medicare and Medicaid shortfalls, and concerns there. All this different entitlement spending. So there's a really big concern right now about the potential value of the dollar and the increasing level of debt that we have as a nation. Neither candidate has really addressed this. And in fact, I would argue that both candidates are planning to spend more money. If you listen, who knows with all the promises that are made pre-election, right? A lot of this stuff doesn't materialize. We could have a split Congress, or they just say, hey, doesn't make any sense. But if you look at everything they're telling us they're going to do, I think both are going to say no taxes on tips, which would lower taxes. I think Trump has come out and said no taxes on Social Security payments and things like that. So if you add up all the things that they're going to give us with our own money, it's just a lot more debt on top of what it's already ballooning. It's shown no signs of slowing down and no talk of slowing it. So the interesting thing though is the dollar has gone up in value. The dollar has strengthened over the last 3 or 4 months. And really, I think the reason for that driver is just where we sit as a country versus the rest of the world. Okay. So economically, things are humming along relatively well. Tim alluded to this. Consumers are still spending very strongly in this country. Anybody that's traveled here in the last year, and even recently, or gone out to eat in the last few months, sit-down restaurants are packed. It may not be the case at fast food type of places, but sit-down places have been really busy. Airports have been slammed. I mean, almost every time I fly now, I get an option to, how much would it take for you to be booted from this flight, kind of thing. Almost every flight I'm getting that, and the flights are pretty full, relatively speaking. So people are spending. GDP has been really strong. There's been a lot of government spending, but a lot of consumer spending too. So those things have helped the dollar. And as we view the dollar across the globe, it's been, again, positive versus the rest of the globe. But these levels of debt certainly could change the trajectory and course of that if something isn't done to address it. And it doesn't look like anything's being considered to address that right now.
Okay. All right, Tim, I want to switch gears and talk about lending. How's lending looking for credit unions? How are the auto and mortgage markets looking right now? And what impact could that have on credit unions?
Wow. So yeah, this one is one I feel like we could talk about for maybe hours, but just kind of trying to hit the high points. I mean, certainly, loan growth has come down significantly from the COVID highs. During COVID, we were seeing double digits up to, I think, 20% in 2023, looking at some of the America's credit union stats. And, now we're down to 2.5%. So certainly lending has backed off for a number of reasons. I mean, you look at the auto industry, certainly rates up has hurt things, but just the prices of autos are significantly higher, both, in new autos with all the tech that's being packed in, and certainly we saw the constraint in supply from COVID. We've got that supply, I think, largely back now. Just anecdotally looking on lots, and the fact that now you're starting to see some incentives for manufacturers to try and move some of those vehicles. So that it's been tough to sell the inventory now that they've brought it back up. So I think auto loans are still difficult to make, certainly because of rates, certainly because of price of vehicle. I was reading an article and had some of the statistics from Edmunds in there that now a new auto deal is on average over $40,000 at a term of 69 months. Before COVID, it's about $33K for about 70 months. So that's $178 per month difference when you look at cost, and that's really significant for people. So auto loans have definitely fallen off. Used auto loans, still the same issue with prices, right? We had that rapid run up during COVID, because of supply constraint on new. And although used auto prices have fallen back some, they haven't fallen back enough where it's certainly like it was prior to COVID. So folks are still struggling with prices there too. And, then that kind of brings in the challenge for credit unions on the other side, not only, making new loans, but making good new loans, because we've seen delinquency certainly rise, after COVID here. And we thought that after the COVID money was gone and, things got back to a little more normal, that we'd see delinquencies normalize. And certainly that has happened and maybe gone a little bit beyond what we would say was normal prior to COVID. So, it's a challenge to make loans, and I think a challenge to make good loans, especially in the face of the fact that, loan losses are up a bit as well. So the mortgage market, I think, is a bit of the same story. I mean, certainly we saw the backup in rates a bit as the Fed cut, but now the yield curve has shifted again, and that's pretty much gone away. You still certainly have supply issues out there, certainly for existing homes. We talked about this before. Folks don't want to give up, the low cost mortgage that they have to refinance. You've got investors in the market now that are kind of taking up some of that supply. So definitely existing home supply is an issue, and new homes have kind of bumped up a little bit. But again, rates have moved back up too. So you've seen mortgage applications both for existing and new home sales fall back in October. So I think, traditional mortgage lending, auto lending, more constrained certainly than it has been. Have to make sure you're making good loans. I think there's opportunity. There's certainly, we know cards have risen. That can be a good or bad thing. Certainly for those folks that are starting to live off their credit card, that's not a good thing, and that's a challenge. But home equity loans are kind of, have been growing for credit unions. That's some of the replacement. For the first mortgages, maybe they're losing. Folks are, choosing to take some equity out of the home, fix up the house, do the project. Maybe they wouldn't have done if they were going to move on, if they were, in different times where they just buy a new house. Now they're going to do something to the existing house. So I think there's still some opportunity there, but, definitely more of a constrained lending environment than certainly we're in the past few years.
Yeah. All right. I mean, I'm just going to say every house that goes on the market in my neighborhood, it's gone within a few days. So when you talk
Absolutely.
about the supply, it's just crazy how fast that's happening.
Absolutely.
But thank you. So Scott, looking ahead, now I know you kind of answered this, but I know it's several weeks off, but what do you think will happen at the December FOMC meeting? You kind of said maybe 25 basis points. What factors do you think they're going to be looking at to make that call in December?
Yeah, so December gets a little dicier. Let's say they go in November for 25, and then what do they do in December? So obviously we'll have a new president-elect, not in office yet, but we'll have a new president-elect. we'll know maybe a little firmer on what their policies might be. Trump has told us there's going to be a lot of tariffs. He's going to, I think he said 60% on China and 10% on the rest of the globe for tariffs. So the Fed may take that kind of stuff into account, but especially as president, the president has a lot of control over tariffs. Doesn't necessarily need Congress to agree with them. They can impose these type of things. But certainly, I think the election will have an impact on the Fed. So if we come out of the election and there's one party control. If one party happens to win the presidency and control both chambers of Congress, then they could get more of what they want, and the Fed may be attuned to that. Everything's really close right now. It could go one way or the other across the presidency and both chambers of Congress. So it's really hard to tell. I think normally, for me personally, I like it when we have a split government, and that way we tend to have a little bit of working together to kind of get some bills that those are ones that generally make sense for us as consumers. But unfortunately, we're in a time when that may not happen. There's a lot of disagreement, obviously politically. So, but I think, based on what I can see, based on what we've been seeing, strong GDP, employment numbers that have held up and are still pretty strong, even though there was a little bit of weakening, but still really strong, especially by historical standards. Inflation continues to come down. Core inflation has gotten a little bit sticky here the last month or two, but it's still a much lower level than we were before. So as long as the Fed will continue to look at inflation, but their focus is going to be really on the employment side of things. So as long as employment doesn't get weaker, I think the Fed will do 25 in December, 25 in November, 25 in December. As Tim talked about it, there is a lag. By the time the Fed makes cuts, it's generally considered, a few months, 6 to 9 months before it actually filters through the economy. So I think, barring anything really unexpected, like a really high inflation rate, which we don't expect anytime soon, a spike in inflation, or something along those lines, that the Fed will just do 25 November, 25 December. But we're going to have a couple more inflation readings before that December meeting. We'll have a couple more employment data readings. And then we're going to have, the unemployment rate to look at, which again has been at 4.1% recently, which is historically a really strong number.
Tim, what else should credit unions be looking at in the months, in regarding the economy and the markets?
Jamie, I'm not sure that I have a whole lot more to add to what Scott says. I think my thoughts are similar. I mean, certainly we've got another PCE reading, which is the Fed's preferred inflation measure here before the next, rate decision, as well as employment report. And like Scott said, the Fed's eye has certainly shifted toward the employment side of their dual mandate. So certainly watch those numbers going forward. And, the consumer, like you say, the consumer's 70% of the economy, right? So that continues to drive the economy and will. So as the consumer goes, so goes the economy. So I think, Scott talked about all those things, and I think, I'm certainly in agreement. Those are the things to watch going forward.
All right. All right. Scott, any final thoughts for our listeners today?
I think kind of what we've been preaching for the last year or so, Tim and I both, is really listen to the Fed, listen to what the Fed's saying. So we're in a quiet period right now until a couple days after the next meeting, but just listen to what the members have to say, pay attention to the minutes. And obviously the two things that we've talked a lot about on this call is look at the employment data and look at the inflation data. Really, the employment data is the driver right now. The early indicator for employment data are the continuing claims data. They come out on a weekly basis. It kind of gives us a good idea if there's a lot of layoffs. We'll see that in the initial jobless claims, and then in the continuing claims they'll build. So, and we haven't seen that. The one other thing I would say to look at, as Tim just talked about, is as the state of the consumer. Is consumer confidence still hanging in there, and are the consumers still spending? So far, it is two economies right now, right? There are a lot of folks that are struggling, but there's still a lot of people spending money out there, and they're keeping the economy rolling. So those are some areas that I would keep an eye on.
Okay. Tim, any additional thoughts?
Yeah, I guess just to add to that, I would say, don't fall asleep on liquidity. Liquidity, certainly everybody's kind of, most anyway, I think have kind of normalized. Things are certainly a lot better than they've been, but, just as we talk here about not really sure which way things are going to go economy wise, and we're still kind of in that beginning of the rate cut cycle. So anything can happen. So certainly don't fall asleep on that. I know a number of credit unions still likely have bank term funding loans out there that you'll need to decide, unless you're in a state where you don't need any of that funding anymore, how you have to replace that. And, portfolios took such a beating that, I think some folks maybe have stopped looking there for a while, but as rates move, as we get closer to the maturity on these bonds, keep an eye on that. You might get some deals in there where you might be able to sell some for liquidity if you need it that you maybe didn't think you had, but certainly check in, with your broker, check in with our folks, and we can certainly update you on that and tell you where things are. So.
Well, as always, thank you both so much for joining me. Really appreciate your insights. So thank you. All right. This episode of Financial Minds Meet the Experts is brought to you by Vizo Financial's Payment QSO MyCU Services. At MyCU Services, we have one purpose: your credit union success. When it comes to payments and core processing services, we believe the cooperative movement is the best path forward. By combining resources and purchasing power, your credit union can accomplish more for less. Find your unique path to success by exploring our extensive offering of products and services, and then pick and choose what works best for your credit union. Learn more at www.mycuservices.com. As always, thanks for listening and make it a great day.